So recently, OpenAI launched their new ChatGPT, ChatGPT 5. And everybody seems to be talking about it. A lot of people love it, a lot of people absolutely hated it. So they implemented some changes to it apparently, and now I don't even know. I don't even know how it compares to GPT-4 and what are the new improvements and, the amazing new reasoning that OpenAI claims that it has. But I wanted to test it. And I thought it would be interesting to record this video and ask ChatGPT some of the business finance questions. Some of them will be easy, some of them will be harder, and just to see what it responds. And then I can react to those responses and just talk about what it got right in my opinion, what it got wrong maybe, or what it missed, or how I would answer differently. I prepared 10 questions, and I tried to structure them from the easiest one to the hardest one, in my opinion. And the topics range from how business can improve its cash flow, which KPIs to track, client profitability, project scoping, and ChatGPT's take on budgeting and forecasting, as well as some M&A prep advice. So this will be interesting. I didn't ask it beforehand, and I created a new project in my ChatGPT account just so that it doesn't have any access to my memories or to its memories of me rather, because I might have fed it some information about my thinking and my strategy. So I want this to be raw. I want it to be sort of what an average person will get when they ask ChatGPT these questions without it having access to expert opinion already. Okay, so without further ado, let's dive in. Oh, and I forgot to say, when I ask a question, before I look at the answer, I will give you some pointers about what I expect the answer to be. So it should be interesting. Okay, first of all, let's ask ChatGPT to act as a business finance expert. Okay, first question. Does business leadership need financial literacy? In my opinion, it very much does. So the short answer I would expect from ChatGPT is yes. But to expand on it a little bit, I think that it's very important for business leadership to have financial literacy, just because all of their decisions ultimately have impact on financials. So not everybody understands this connection. Not everybody understands that, if you have somebody sitting on a bench, you still pay money for them. So without those people producing any revenue, it impacts your bottom line. Hiring decisions impact finance, marketing campaigns cost and effectiveness impact finance. So really, it's about this connection, and it's about knowing the power of data as well, because finance tends to be the gatekeepers of all data, not all, but most of the data in the organization. So knowing this connection, I think, is the core of the financial literacy training, or understanding this connection. So let's see what ChatGPT says. Okay. It says, absolutely, business leadership does need financial literacy. That I agree with. Here's why. Strategic decision making. Leaders often decide on investments, expansions, pricing, hiring, and cost management. Without understanding financial data, these decisions risk being based on gut feeling instead of facts. Yeah, 100%. Leaders do decide on investments, on expansions, on pricing, maybe not individually, maybe as a collective or in conjunction with the CEO or the CFO, but they do have a lot of say in this, especially if some of those leaders are responsible for budgets for their departments or for their teams. So yes, a lot of those decisions do impact finance. And without understanding the financial data, those decisions, they become decisions based on gut feeling. Decisions based on gut feeling is not necessarily something bad, but I feel like when you combine gut feeling with the data to support this gut feeling, or just to analyze the pros and cons of a certain decision or compare different options, that is really powerful. And I think if you are able to, well, recognize that you need the data, because a lot of times finance just sits on huge amounts of data that could be useful to other teams and other departments and leaders, but they never offer it up. Or sometimes they do, but those leaders don't know what to do with this data. So I think it's very important for them to understand that this data exists, that they need it, and how to use it to maximize the decision-making quality. Second point that ChatGPT mentions is communication with stakeholders. Executives need to communicate effectively with investors, lenders, boards, and shareholders. That is true. Executives are expected to deliver updates to the board, updates to the CEO, and without knowing how to explain their decisions with, supporting them with the financial data or through a finance lens, it becomes hard to find contact with those stakeholders. So I agree with this. Financial literacy helps them interpret statements and explain company performance in a credible way. Not necessarily in a credible way, but in a way that ties their decisions and impact of those decisions to the financials. So when you deliver a report on your department's performance for the quarter or for the year, you can explain what happened, what decisions you made, how it impacted the organization or your team. Because board tends to pay close attention to the financials. So if you as a leader can bridge this gap between your operations and financials, that's a huge plus. Third, risk management. Financial literacy allows leaders to spot early warning signals in cash flow, margins, or leverage, helping them mitigate risks before they become crises. I wouldn't say that a lot of business leaders worry about cash flow. To me, that's the priority of the finance team and the domain of the finance team. And even if some of the leaders are responsible for certain parts of the budget, they usually are responsible for the impact on the profit and loss statement. But cash flow, that's related to balance sheet. That's the actual cash. So I would say not really cash flow. Margins, for sure, if they are responsible for either for the margins or for the expenses. So as long as finance is able to deliver this information to the leaders can impact on this information. Yeah. Margins, they would be responsible for margins then. And also spotting early warning signs. That's a good call out, because I feel like if you're able to read the data and you can see that there's a trend, that something is going in the wrong direction in your organization or in your department, you are able to act on the data and you're able to see numerically what's going on, as opposed to just guessing and kind of not knowing what to do or what is wrong. So I think that's powerful. Number 4 is resource allocation. Leaders with strong financial skills know how to prioritize resources and maximize return on investment. They can distinguish between high impact and low impact uses of capital. Yeah, I would say if they are responsible for budgeting or for parts of the budget, then yeah, resource allocation is key in that case. But I feel like you cannot really make leaders responsible for budget when they don't have financial literacy. It's like putting somebody in the driver's seat without showing them or teaching them how to drive first. So yeah, prioritizing resources, that means you're, for example, if a leader is given a budget, there are multiple ways that they can allocate this money. They can allocate the money for new hires, for team training, for new software, for conferences, for certifications, for example, for hiring new leaders. So there are a lot of ways to allocate those resources. Here it says maximize return on investment. I don't think you should be reading this literally. I think a better way of thinking about this is maximizing every dollar to bring the most benefit to your organization. Okay, number 5, long-term sustainability. Understanding the financial health of the business ensures that growth is sustainable, not just driven by sales or expansion without profitability. I think what ChatGPT means here by sustainable growth is making sure that you're not doing anything stupid. I mean, it's saying here, not just driven by sales. I think what it means here is sometimes when you sell something, you should also be able to deliver on it. And I've seen sometimes companies sell services to deliver a project, but they don't have enough internal resources, or those teams are just not trained to do this kind of work. So it becomes kind of a chase to staff in time to find the resources that will be able to do this work, to gain the knowledge that is required. And a lot of times it just becomes a mess. Pretty much every company has its own set of horror stories about failed projects. So that's what happens when you don't sell sustainably. Same with expansion. I've seen acquisitions happen, and with a failed integration process, which, by the way, we'll talk about later in the video, we'll ask ChatGPT a question about integration post M&A. But I've seen that if this is not done properly, then everything that you've gained from this new acquisition is just going to get lost. People will quit, clients will leave you, and you won't be any better than before the acquisition, and you might actually be in debt because of it. So everything needs to be done in a very measured way. And I like that ChatGPT mentions profitability here, because a lot of times there's revenue, but the bottom line is not looking great. And what that means is you're not managing expenses properly, so something is not working. Either your resources are not used effectively, and I mean, the delivery teams are not efficient, or they spend too much time than what was initially planned in project scoping, which we'll also talk about, by the way. So I agree that profitability is key. Okay, let's see what it wrote next. In short, while leaders don't need to be accountants, a solid grasp of financial concepts is essential for making informed, sustainable, and strategic business choices. I agree. Okay, that was a good answer. I liked it, and it wasn't super detailed, but I think it was detailed enough to be able to explain the main benefits and maybe compel leaders to find some information about finance literacy and become more financially literate. Okay, that was good. Let's ask the second question. The second question is a little bit more difficult. It's, how can a business improve its cash flow? Next question. How can a business improve its cash flow? Because I feel like a lot of people ask this question, and I would be curious to see what ChatGPT thinks. When it comes to improving the cash flow, I think some of the things that ChatGPT might be answering with would be better collections, less spend on something that's not entirely required to produce revenue. So if there are certain things that don't really result in bringing more revenue or delivering already sold projects more efficiently, those are the two main things I think ChatGPT will also will mention. Another point I would be happy to see in its answer is the cash flow forecast. So let's see what ChatGPT says. Okay, cash flow is indeed the lifeblood of any business. Even profitable companies can fail if they run out of cash. That is very true. Here are practical ways to improve it. Speed up cash inflows. Invoice promptly, don't delay billing, send invoices as soon as work is delivered. Yeah, so I think I mentioned it before in one of my videos, but it is very important to have a solid invoicing process. Once you finish a month, then you need to start invoicing at the beginning of the following month. So dedicate days 1 through 3 or 1 through 5, depending on the amount and complexity of your invoicing, to this process, and make sure that whoever on your team needs to be freed up to be able to do this quickly, that this is done. Shorten payment terms. Move from 60 to 30 days or less if possible. Well, that's a good advice in theory, but in practice, that's not really practical. You could, for all your new clients with whom you sign new contracts, you could try and negotiate starting with net 30. In fact, this is something that I suggest your legal template should include by default. But in practice, I've seen a lot of pushback from bigger companies Those companies with heavier accounting teams or more sophisticated accounts payable cycle, they are pushing for net 60. Sometimes they're even pushing for net 180. I've seen that as well. So yes, you should always try to get net 30, but in reality, that is not something that you can always do. Offer early payment discounts, 2% off if paid within 10 days. Not a fan of those discounts. They're a pain in the butt to track, and they are just not super practical. You can try, but I'm not a fan. And also, I think a lot of organizations just have this rigid accounts payable life cycle where instead of paying something within 10 days and getting 2% back, they would just wait until 30 days and then pay. It's just easier for them. Use digital payments. Make it easy for customers to pay quickly. Credit cards, ACH, online portals. Well, that depends. Credit cards, they take a cut. And if you are okay with that, and if you'd like to get cash more quickly, but that would mean that you would have to pay some cut to the credit card service, that might be a good option for smaller invoices, maybe within 2,000. But for bigger invoices, the amount of fees that you're going to pay is just going to skyrocket. So I wouldn't recommend this for major invoices. ACH, yeah, that's a good one. I usually recommend, reaching out to new clients when you sign them and telling them that your default payment method is ACH. Some clients will be stubborn. They will keep sending you checks. There's not much you can do about it. Just hope that they will be reliable enough to send them on time and that the postal service is not going to crash all of a sudden. But yeah, that's a good advice to make it easy for customers to pay through ACH. Online portals, yeah, sure. A lot of clients would appreciate that. Next one, manage outflows wisely. Negotiate better terms with suppliers. Extend payment terms from 30 to 45 days. So that is something that you can try to do when signing new suppliers. Again, it's kind of the same thing as with the clients, just the other way around. You can try and push for more days. Not everybody will be able to give you that, but some will. When it comes to your existing suppliers, just reaching out all of a sudden and asking them to extend your net 30 to net 45, that will require some sort of explanation. I remember I had to do that during COVID when it started. Not because my organization was not doing well, but we would proactively reach out to our suppliers just to make sure that in case something happens, we won't be too strapped for cash. So, and there was a lot of uncertainty with our own clients, so we were just trying to maximize our cash retention as much as possible. And in that case, I would reach out and I would just ask for some grace. I would tell them that, because of the pandemic, we're trying to, be a little bit more careful with our cash. So I would just ask them if it's possible to update our payment terms, and I would only ask for it to be done temporarily. And if you said yes, and if you said no, so that's a good option. 10, payment strategically. Pay on the due date, not early, unless discounts apply. Yeah, if you're strapped for cash, don't pay early. Keep the cash. Also, sometimes if you pay a day or two after the due date, again, it depends on what kind of vendor, how flexible they are. Sometimes that's fine too. I don't advocate for this. I usually prefer to have my accounts payable settled on time. But if you're in a situation where cash is complicated, it's fine. Everybody does it. If you open your accounts receivable report, you will see that a bunch of clients are not paying you for 30 days or 60 days. You could technically do the same. Just pick and choose which vendors will be okay with that. Again, I don't advocate for this as a normal course of operation, but in situations where you really are strapped and you don't know what to do, I think that's a good approach. Control overhead. Regularly review expenses like subscriptions, utilities, and rent. Subscriptions, 100%. I have a video about subscriptions and how important it is to review subscriptions because those can become black holes of expenses that you keep paying that nobody uses those subscriptions. Utilities, I don't see a point in reviewing your utilities because as a business, if you operate from an office, what are you going to do? Turn the lights off? That's not feasible. So a lot of times you're kind of stuck with your utilities the way they are. Same with rent. When you sign rent agreements, they usually lock you in for 3, 5, 7, 10 years, and they have the right to increase your rent. It's all in the agreement usually. But there's not much you can do if you just review it. Well, yeah, you can review it, so what? The only thing you can do is move. Break your agreement or, sublease it to somebody, but there's not much you can do other than move. Same with utilities. You can't just not pay for your electricity or for your water. You kind of have to do it as a business. So that advice, I like the subscriptions part. I don't like the utilities and rent part. I think it doesn't apply. Okay, next thing, lease instead of buy. For equipment or vehicles, leasing may free up working capital. That could. It all depends on your purpose. Because if I'm thinking about a service business, which is my specialty, in terms of equipment, we usually buy computers, monitors, general office stuff. So for computers, you could lease them, and I've seen that done, but it's not always feasible. Just because I've seen a lot of times a scenario where a fast-growing company hires somebody and they're starting in a week or 2 weeks. And with all of the onboarding and the tight timelines, sometimes our IT person had to literally run to the mall next door to the Apple store to get a MacBook. They would buy it. They would not lease it, of course. But that would mean that the new person that's just starting, they would get their computer on time. There is nothing worse, in my opinion, in the onboarding experience as a new employee when your computer does not arrive on time and you have to find workarounds. You either have to work from your personal computer or you have to run and buy your own computer and then get it reimbursed. That's such a mess. And I feel like with leasing, unless you are an organization that hires frequently and a lot and has a very, very well-run process for ordering new stock for laptops, leasing would make sense. But sometimes you just have to buy. Okay, third one, optimize inventory. I'm going to skip this one just because I specialize in service businesses. So I have never really worked with businesses that keep inventory, so I don't know much about it from the practical standpoint to be able to comment on it. And I should have probably specified to ChatGPT to think about a service business when it answered, but that's fine. Increase revenue. Well, it's easier said than done, but let's see what it says. Upsell and cross-sell to existing customers faster than finding new ones. Yeah, that works depending on your business model. It's always cheaper to sell to an existing customer than to a new one. So if you're able to do this, absolutely go for it. If you're looking for ways to improve cash flow quickly, that's not one of them probably, because you need to sell, then you need to negotiate the terms, sign the paperwork, and then deliver the work. So that will eventually give you more cash, but it will not be quick. Also, another point, if you upsell and then you don't deliver the work efficiently, meaning going back to our original point about client profitability, meaning your project is not profitable, so you used more resources than you had to be able to achieve a healthy client margin, that is not going to increase your cash. Because you would need to potentially either hire more people or pay your existing people higher salaries, or even take people from other projects and put them on this one. So you will lose some revenue potentially on other projects as well. It's not a clear-cut answer to cash problems. It could be beneficial if it's done the right way, but if you have cash problems to begin with, chances are you're going to replicate the same model when it comes to the new projects that you sell. So be careful with that. Adjust pricing. Small price increases can improve margins and cash. Yeah, you could, but it needs to be done strategically. You cannot adjust prices too often. You cannot adjust prices too significantly, and also sometimes your contract just would not allow you to do this. For example, if you sign a contract where your price is locked in or you have a long-term project, where you just sold it for a price and you have to deliver on it. So that's not always feasible. If you have a retainer or a subscription model, you could, but again, it all depends on what you negotiated initially. For new clients, you could up your prices, but again, you cannot really deviate from the market too much. And that's why I like benchmarking against the industry, because if you are underselling, or underpricing rather, that would be good to catch and update your pricing for all new projects that you sell. But if your prices are too high compared to the industry, if you increase them even more, you're going to lose existing customers potentially. So be careful with that. That advice is, a lot of the advice here is solid-ish for certain situations, but it's very nuanced. So you can't just blindly follow it. Diversify income streams. New products, services, or subscription models can stabilize inflows. Again, at what cost? Because to develop new products or services or subscription models, you likely will need to invest in this. And how are you going to pay for it? To develop new products, you probably would need to do some R&D. This costs money. To develop or deliver new services, if they are new, you either have to train your team, which costs money, or you have to hire new people, which costs money. So, again, in theory, that sounds good, but in practice, you cannot really diversify your income streams this way if you don't have cash to begin with. So this advice, in my opinion, is no bueno. Okay, 5, strengthen cash flow forecasting. Yes, I like that ChatGPT mentioned that. Project inflows, outflows monthly to avoid surprises. No, not monthly. Do it weekly. Update it weekly, and have a rolling 13-week cash forecast. So look ahead for the next 13 weeks and update it every week. No exceptions. This is the only way you can manage your cash reliably. So no, not monthly, weekly. Use rolling forecasts. Always look 6 to 12 months ahead. No. Use 13 weeks, just because you cannot predict cash for a year ahead or even 6 months ahead. Honestly, even with your cash forecasts for 13 weeks, if you look at what you projected for a certain week 12 weeks ago and what's actually happening, those are going to be vastly different. Just because you can estimate and you can plan, but you never know exactly when the client will pay you cash, or when HR will hire a new person, when they're going to be able to start, when their addition to payroll will hit for the first time. So there are a lot of moving parts. The best thing you can do is you can estimate so that on a high level, you are ready and prepared. But trying to look ahead 6 months, that's unreasonable. That's unrealistic. That's just not going to be useful to anybody. You're just going to spend all this time planning and creating this forecast when it will not have sufficient level of detail, because you don't even know who your sales team is going to sell to in the next 6 months, or even a year. And 2, you don't know if circumstances will change that you all of a sudden will hire a bunch of people, or there will be a series of layoffs. Don't bother. Just plan for the next 3 months. Okay, stress test. See how cash holds up if sales dip or costs rise. I don't see the point in doing the stress test. How are you gonna test it? You can model, yeah, and that's part of your cash forecast. So you can, when you create a cash forecast, you list all of your projected cash inflows and then all of your projected cash outflows. So you can play with some scenarios. So for example, what if this client will pay you this huge invoice, not this week, but that week or 2 weeks later? Or let's say payroll gets increased, or, software renewal will be 10% higher. You can play with all of those scenarios and see how they impact your forecast and your ending cash balance. But what's the point? Just plan the most reasonable scenario, the one you expect. If you want to be more prepared, you could assume the worst case scenario and plan in accordance with that, but you don't have to stress test. Just do some basic scenarios. And number 6, access financing if needed. Credit lines, maintain a line of credit for seasonal or unexpected needs. Yeah, I don't get the businesses that don't have a line of credit just because it's relatively easy to get. It's not particularly expensive, especially if you don't use it all the time. And it's a good buffer to have in case your cash suddenly dips. So that's a good advice. Invoice factoring financing, sell receivables for quick cash. To be honest, I've never tried this. I've seen other organizations that we worked with do that. It might be a good advice. I don't know, but I feel like my gut feeling is telling me that something is not good with that. I feel like maybe reputation wise, if you sell your receivables to somebody and then they go and pester your clients, it's not a good look on you, and then your clients might be having a WTF moment when somebody calls them and tells them, oh, by the way, this company sold us your receivables, so now we're going to be the ones that you deal with. I've had that experience. I was on the other end of the line and I was like, okay, but it's just a little weird. But again, if you're looking for quick cash and it gives you what you need, sure, go for it. Why not? Short-term loans, only if cash gaps can be managed internally. You need to be careful with those. Just because a lot of businesses that I've seen having cash problems, it's not something that is that happens once and then goes away. A lot of times those businesses have chronic cash flow problems. And so if your strategy to deal with those is short-term loans, that can quickly become dangerous because short-term loans, depending on the urgency, might not have the best interest rates and not the best terms. So you don't want to box yourself into a situation where you try to solve your cash flow problems with some quick cash, but now your problems are even worse because of this decision. So be extremely careful with this, only if you know it's temporary. If your cash problems are temporary. Only if you know that your organic cash inflow will arrive to your business. Like if you're expecting a big client payment that will solve all of your problems for the next little while, and you'll be able to repay the loan right after this payment, that does make sense. But don't rely on loans as your business strategy. The goal of having a business is generating cash. So if your business is not doing this, especially if it's not doing this chronically, there's something wrong that needs to be fixed in your whole business model the way it is right now. Okay, a business can improve cash flow immediately by tightening collections and controlling outflows. Yes. While longer-term improvements come from better planning, inventory management, and strategic pricing. Yeah, I agree. And we talked about some of those things that are easy to do in the short term. And I mentioned that some of the advice here is primarily long-term. Nothing wrong with that. You just need to know when to expect miracles overnight and when to not. Okay, let's try our next question. And the question is, how can you understand if your finance team is good? That's a very broad question, and I'm curious what ChatGPT will respond here. The first thing that comes to mind for me is they should be organized. They should be able to produce the required things on time. Their reports should be easy to read. They should have those reports. The finance team should cover all of the functions that is required from a business's finance team. Again, the depth of those depends on the business size, but the primary functions are accounting and FP&A. So if you have somebody on your finance team performing those functions and doing it well, then I would say the finance team is successful. If something is missing, if you as a business leader don't get FP&A support, if you cannot get the data on time or in a format that is usable for you, or if the month close process for the finance team takes forever, or if you're not getting a lot of reports from them, a lot of useful information, that usually is a red flag. So yeah, let's see what ChatGPT says. I forgot to say. Next question. A good finance team is more than just people who close the books. They should be partners in strategy, decision making, and growth. I agree 100%. A lot of times, business leaders think about finance as just somebody who records transactions for whatever reason, because it's expected, probably to pay the taxes. And those who eventually file the tax returns or work with whoever with external accountants to file those tax returns. They don't see the value in the finance team, or they cannot even understand what kind of value finance team can bring to them personally for the benefit of the organization. It always makes me sad that a lot of people still don't know what a powerhouse finance can be and how helpful it can be for the business's growth and success. So I like that ChatGPT mentions here that they should be partners in decision making and strategy and business growth. Okay, here's how you can tell if your finance team is good. Accuracy and reliability. Yeah. Financial reports are accurate, timely, and error-free. Yes, 100%. Monthly closes happen consistently without constant corrections. And I should add, they are happening quickly. A, they are happening, and B, they're happening quickly. Because I've seen finance teams that don't fully close the month, and they always go back and make adjustments and make cleanup and no, month should be fully closed, reports issued, and you move on. And it shouldn't take the finance team forever to do this. So if your finance team closes the month on day 30, no, it's day 15 is like the cutoff. By day 15, that's okay, that's good. But later, no. You feel confident relying on their numbers. Yep. Yeah, you should be able to. Cash flow awareness. They track and forecast cash flow proactively, not just report after the fact. Yeah. And we talked about the cash flow forecast and how important it is to project cash and make forecasts. They alert leadership about upcoming shortages or surpluses in advance. Yes, but they also need to be able to not just alert, but suggest workarounds or suggest options to mitigate the risks or improve the situation. Because when it comes to cash shortages, what can the leadership team do? They're not going to call the bank. They're not going to call the clients and ask them to pay quicker, or they're not going to call the suppliers and ask them to extend their terms. This is all on the finance team. So finance team should not just alert, they should actively find ways to optimize and improve, and only report on the results of their work once they were able to do this. So they should alert, yes, but it doesn't end there. They should also try to make the situation better. Strategic insight. They don't just present numbers, they interpret them. And they should interpret the numbers for the leaders, but leaders should also be financially literate enough to be able to read those numbers as well. They provide KPIs, trend analysis, and what-if scenarios to guide decisions. Yeah, and that is a huge part of the benefit of having a well-trained finance team, because KPIs, how can you know what's going on in your business without tracking your major basic KPIs at least? Trend analysis, how can you see where you're going if you're not looking at your history and not looking at your trends? What-if scenarios, how can you make decisions? How can you understand the impact of your decisions on the financials if you don't run those scenarios? And you need finance team to be able to support you in this. Example, instead of just saying expenses rose 8%, they explain why and suggest ways to control it. They cannot fully explain why. They can tell you what they see. So for example, if they say expenses rose 8% in office meals, for example, they cannot tell you why. They can just tell you that we as a business started spending more on office meals. And then the next question is, who is the budget owner for this? Who is the budget owner for office meals? And was this increase in the budget? Or this increase is unplanned, unexpected, and should be corrected? Suggest ways to control it? Not always. Again, back to my example about the office meals. How can they control it? Finance, only whoever owns the budget can control it. Finance can make suggestions and recommendations, but ultimately they cannot control it. Same with hiring. They can look at payroll and say, oh, our payroll costs increased by 10%. Again, the first question is, was that in the budget? Was that planned or no? And if it was in the budget and it was planned, great, you're on track. But if it wasn't, then the next question is, whose budget is this? Who was the budget owner for this increased expense? And were they ready to see this increase? Maybe it was a conscious decision by them. But if not, then you need to investigate further, together with this person who's responsible for the budget. Finance can just guide. Okay, next one, business partnership. They collaborate with other departments, sales, operations, HR. 100%. They should collaborate. And when I was in my finance roles within organizations, I constantly collaborated with pretty much everybody. There's just no way around this. If you want to be a helpful part of your organization and impact the decisions and strategy and just know what's going on to be able to even do your job properly. They explain financial concepts in plain language so non-financial managers can act on them. Yes, good finance people. And again, this is something that I would expect from leaders mostly. I don't expect your average junior accountant to be able to go out to a business meeting and explain financial concepts in plain language. I would expect something like this from a finance director level or a VP or CFO. They should serve as the bridge between technical financial concepts and technical financial terms and translate them to the business language so that everybody can understand it. But again, going back to my point about financial literacy, it is easier for them to translate it when the leaders are financially literate. Okay, let's see what's next. They're seen as enablers, not blockers. Yeah, and it's very sad because sometimes I see finance teams that are seen as something that's very strict, that doesn't give people what they need, that are mean, that are not helpful. And I feel that it shouldn't be this way. And, it could be a whole other 1 hour discussion about the reasons and possible causes of this situation. But finance should be seen as somebody who helps, who can answer questions, who is easy to work with, and definitely not blockers. But again, yes, I understand that finance should be strict. Finance should be the gatekeepers of assets. But in a well-designed organization, when there are budget owners responsible for expenses and budgets, and not just finance who oversees all of this, it becomes easier for people to like finance more because all of this decision-making power is not consolidated within their hands. Okay, compliance and risk management. They ensure compliance with tax, legal, and regulatory requirements. Yes, 100%. Your finance team needs to be able to do all of this. And if they don't know certain tax laws and regulations, they should just reach out to an expert and get a consultation. But ultimately, yeah, it's on them to be able to maintain all of the required reporting and filing of government reports. Payroll especially is a big one, and that's where a lot of businesses get burned. When it comes to legal, usually I would put legal under the privy of CFO. So that could be part of finance for sure. Internal controls are in place to prevent fraud and errors. Yeah, that should be done 100%. It's not so easy to do for smaller businesses where finance team is just 1 or 2 people. But you can always segregate certain functions. So for example, you can always make sure that every payment in the bank has at least 2 approvers. Yes, that's a pain in the butt, but there's no way around this if you want to prevent fraud. 100% prevent fraud. Audits, internal or external, go smoothly with minimal surprises. Yeah, audits should go smoothly. When auditors find a lot of things that need corrections, that means that your finance team is not doing the best work that they could. If your audits take a lot of time And sometimes it's not the fault of your finance team. Sometimes it's the auditors. But if they take a lot of time and come back with a bunch of corrections and adjusting entries, a lot of back and forth, that's a red flag usually. Next one is technology and efficiency. They leverage tools, ERP, dashboards, automation for faster reporting. Yeah, a good finance team needs to balance manual and cheap versus automated and more expensive. So some things make sense to be done manually, and it depends on the size of the business too. But sometimes it's just easier to get a piece of software that will minimize the manual errors, automate certain things, make things easier so that you don't have to hire additional person to do this job anymore, or you can reallocate your people to do some other more meaningful work than this. So that's the preview of your finance leader. They should be the ones setting the process, making sure that the process makes sense, the workflows make sense, and the tools that are used are appropriate for the business's size and complexity and requirements. Processes like invoicing, payroll, and expense management run efficiently. Yeah, invoicing sometimes is not done entirely by finance. I've seen project managers do that or client service teams do that. So as long as finance is reviewing the invoices and keeping their hand on the pulse, and supporting and helping wherever possible, I think that's good. That's success. Payroll, yeah, sometimes payroll is done by HR. So again, it depends on who owns payroll. But finance, in my opinion, should always be somebody who you can come to, who would be able to help you with your questions or give you the required data. And expense management to run efficiently. Yeah, for sure. Good AP practices, and same with accounts receivable practices as well. Your finance should be responsible for collections too. And again, there are certain tools and software that you can use to optimize both accounts payable and accounts receivable. So that's part of this technology stack your finance leader should recommend. They minimize manual error-prone work. Yeah, they should when it makes sense. Because if it's a very, very small business, you don't want to spend thousands on a certain piece of software where you can do the same thing manually. You only do it once a month and it takes you 2 hours. So yeah, it all depends. But in general, I'm in favor for less manual, more automated, and definitely reduce the errors. Forward-looking mindset. They focus not only on historical reporting, but also on forecasting, budgeting, and strategy. Yes, when I mentioned that finance teams should have the accounting piece and FP&A piece, the way you can view this is accounting is historical reporting, FP&A is forward-looking. So your finance team should be able to service both. And usually it, again, depending on the size of your business, but usually it's not done by the same person because that generally requires 2 different skill sets. People trained in accounting might not be trained in FP&A and vice versa. There are people who are trained in both, and it's good to have people who are trained in both for smaller organizations because they're able to combine both functions in one person. So one salary for 2 functions. But as you grow, you want to separate them. And, obviously your CFO or your finance leader needs to be well-versed in everything. Not to the tiniest detail, but they should know enough to be able to understand what's going on, what is good work, what is subpar work, and so on. Quick self-check questions. Oh, interesting. Ask yourself, do I trust their numbers without second guessing? Yeah, that's a good one. That shows how you feel about your finance team. And usually you have evidence or proof. For example, if you don't trust them, when they've made certain mistakes before, or when somebody from the outside, like auditors or tax authorities, reached out and let you know that something was off. But yeah, that's a good one. Do they provide insights or just reports? Yeah, finance should provide you insights and present the information and promote discussion among the leadership team. So that's definitely one role of finance. Do they warn me about risks early or only explain problems afterward? Yeah, a good finance person will warn you. But also, some finance people tend to be very anxious, just because they feel like the well-being of the organization depends on them because they manage money. So they might be a little bit more sensitive to certain risks, more sensitive than the business owner. And that's where I see mismatch happening when finance person comes and warns and comes and warns and comes and warns. And then the business owner or CEO kind of becomes, it's kind of like the boy that cried wolf situation. They just become numb to those warnings. So it's very important for both of those people, the finance leader and the organization leader, to find balance in this process where they discuss the risks. They either understand how significant the risks and if anything should be done about them, and if they are, what kind of strategy they can implement to manage those risks. Do other departments see finance as a partner or a bottleneck? Yeah, we talked about this. That's a good one. Our process is efficient and tech-enabled or overly manual. Efficiency, 100%. Tech-enabled, depending on your situation. But yeah, if you can reduce the manual, especially if you can do it for free or cheaply, yeah, go for it. Okay, this is taking longer than I thought it would, because I prepared 10 questions and we only discussed 3 of them. So I think I'm just going to do part 2 and potentially part 3 of this video. Hopefully that was interesting, and it was interesting to see what ChatGPT responds and my take on this as a finance professional. So yeah, it was fun for me, and I'm looking forward to the next part. If you liked it, please like and subscribe so that you don't miss the second part and third part of this, and I'll see you in my next video.